Some investors are concerned over the 10-year Treasury potentially hitting 5%. And I have had several client questions on this topic. So I thought today I'd shoot a quick video to share my thoughts on the current environment, which is certainly complex. I believe the volatility that we have seen in the equity markets since mid-December is more of a function of the rapid rise in yields than the absolute value of yields. Data shows that an increase of 2 standard deviations or more in bond yields over a 90-day period creates volatility for equities. And that is exactly what we have seen in yields since the Federal Reserve announced its rate cut during its September 2024 meeting. Since then, the yield on the 10-year Treasury has increased more than 100 basis points, which is a rapid rise. But the volatility tied to rapid increases in bond yields tends to be short-term in nature. So the next question becomes, why did yields rise so fast? Movement in bond yields are normally due to a change in the market's outlook on one of 3 things. Number 1, inflation. Number 2, economic growth. And number 3, uncertainty. And the outlook on these items can paint a positive or negative outlook for equities over the medium term. So let's start with the first one, inflation. Inflation is cooling, and yesterday's producer price index, PPI, and today's CPI data support this conclusion. So on balance, the inflation picture is positive, even if it is taking longer to get inflation down. 2, economic growth. Economic growth by most, if not all metrics, is very strong. The labor market is still quite strong, as evidenced by last Friday's job report. And unemployment is still historically low at 4.2%. GDP is expected to grow by 2.7%, which is also a strong number. I believe corporate earnings for this upcoming quarter will paint a similar picture. And last but not least, uncertainty. This is where I believe most of the volatility is actually coming from. While inflation is cooling and economic growth is strong, there is still a lot of unknowns about fiscal and monetary policy. The Federal Reserve's monetary policy relies on backward-looking data, and the Fed's commentary has been inconsistent and hard for the market to interpret. On fiscal policy, there is great debate about what policies the Trump administration will be able to pass and the impact of those policies, including tariffs, will have on the deficit and inflation. We will have more clarity and more certainty around these issues over time. I am okay with the uncertainty driving the volatility in yields. This is a natural part of investing. I would be much more concerned if inflation and the economic growth outlook looked less positive. A gloomy economic outlook would hurt earnings growth on equities and make it much harder for earnings to grow at a pace that could compete with higher bond yields. Given the outlook I have for 2025, going into today's CPI print, I viewed this pullback as a buying opportunity. This environment is reminiscent of October 2023, where we had an intraday high on October 22nd, 2023 of over 5% on the 10-year Treasury. It then retreated below 4% by the end of 2023. So what happened to the equity markets over that period of time? That period proved to be an excellent buying opportunity as the S&P rallied 14% from October 22nd, 2023 through the end 12/31/2023. We are seeing the exact same thing play out in real time. It will be interesting to see where yields are in the next couple of months. As always, stay nimble and stay informed. Please reach out to our team if we can be of help to you and your family.